Hey, how's everybody on BiggerPockets today? Dave Van Horn here, President and CEO of PPR Note Company, coming at you to talk about real estate note investing 101. How to get started in notes, right? Because that's what everybody wants to know, especially if you're not already doing it, right? So today is one of my favorite topics, exit strategies with your note. And the reason it's one of my favorite topics is it's where the money is, right? Show me the money. And usually, when you're exiting your note deal in some form or any deal, that's when payday comes in, right? So, everybody likes to talk about making money and paydays and big deals and fat checks and all that good stuff, or even some cash flow. I'm happy with both, and I'm sure most of you are too. But before we get into that, I just want to make sure everybody can hear me fine, see me fine. Give me a little shout out, give me a wave, give me a comment, ask some questions, whatever. Feel free to do that. And if I don't get to your question as we're talking, I'll definitely answer it when the Facebook Live's over. So I do try to connect with everybody that I can because I actually like this stuff. So before we get started into today's topic, just a quick recap on what we've been talking about over the last several weeks, because I've been kind of doing a little bit of a series of some things to know, and when you're getting started in notes, the different parts of the business. And I always look at it as, this is my perspective too. It doesn't mean everybody's the same as me, but from my perspective, there's four main parts of the note business. There's the administrative part, there's risk management, there's borrower management, and of course there's exit strategies. So last time I was on, we talked about borrower management, right? And when we were talking about that, it's everything from, especially with non-performing notes, we were talking about initial contacts. Even when you buy a performing note, there's certain letters that have to go out. But with a non-performing note, a lot of times there's a phone campaign or mail campaigns and letter campaigns. And then there's also sometimes you send a door knock service out. There's companies like NCCI that'll go out to a property for you and try to reach the borrower, that type of thing, because you're really trying to get a hold of folks before you take a lot of legal action to see if there's a way to resolve the situation, right? And it's really trying to find out what the borrower intent is when someone is in distress or it's a delinquent loan. Do they want to stay? Do they want to go? And then, of course, if you can negotiate some kind of a, possibly a win-win solution, you will. And then, obviously, you got to implement that agreement. And, we talked about some of those things, on the last call. So I'm sure you could probably go out to YouTube and catch that again if you didn't get a chance. And it's something you're interested in, how to actually handle, the borrowers. It's, some note owners want to do that piece of the action themselves, right? But today we're going to be talking about the fourth part, which is exit strategies. And you notice a lot of these note strategies are similar to real estate strategies, or any investment, right? Don't you want to know your exit before you get into your investment? That's something you'll hear frequently, right? You hear that from, financial advisors, that type of thing, or any type of investment. Know your exit before you invest. And even in real estate, like I'll give you a quick story. I was partners with a guy. We were renovating a house one time. It was actually a firehouse. It had burnt down. And we were renovating his fire job, and his goals were different than mine. His goal was to flip the house. My goal was to keep it as a rental. And little did we know, we weren't on the same page. If we get done the project, I want to go one way, he wants to go another way. Well, obviously, it ended kind of weird. We're still friends. I ended up buying him out. But you want to know your exit before you get into a deal if you can. Now, granted, with things like notes especially, or, even real estate deals, sometimes you go into the deal, you're like, hey, we're here, and there's this timeline that goes by. And when you first acquire the investment or the asset, you're like, hey, this is what I think my exit's going to be, or this is what you might have a worst case scenario and a best case scenario, and you're like hoping to, obviously get the best case scenario, but Sometimes things happen along the way where you get more information, or things develop, or the market changes, whatever it is. Plans change, or you need the money. So sometimes your strategy changes over time, but you do want to try to know what your exit is when you go into a deal or into an investment, whether it's real estate or notes. So let me see if I can see who's joining us today. Maybe you can give me a little shout of where you're from. Hey, Danny, what's happening? It's funny. Sometimes I can see everybody, and sometimes I can't see as much. It's funny how these things work. Oscar's here, crystal clear. Yeah, give me a shout out where you're from. I'm in not so sunny Philadelphia now because it's getting dark early. It's fall, right? Let me see. Aaron's there. Jesse's there from San Antonio. Cool. David Manning, my buddy's on. That's cool. So, hey, listen. So we're talking about exit strategies, and, like I said, that's where the money is, right? So when I think of, exiting my note deal, right? Sometimes obviously you can exit it by selling it, right? You can sell your note, right? Well, if you sell your note, you're exiting it. And then there's also a difference between a performing note and a non-performing note. So if I buy a performing note, granted that's easier and it's simpler. Usually your note is with a servicer. So your exit might be, hey, it goes full term to maturity, and the borrower just makes monthly payments, and there's so many years left on this note or on the modified loan agreement if it was a delinquent loan that was became reperforming. So the borrower just continues to pay every month, and you collect payments just like you do if you're paying your mortgage, right? And you're the bank, right? You're the note owner. So now you're the bank. You're collecting payments through your servicer, and it goes all the way to maturity. And it's kind of predictable. You go, oh, well, that's what I'm going to make, this many payments times this many months. And you can kind of figure out your yield based on, well, how much do I collect over that time period? What kind of return is that on my initial investment, right? Now, the cool part is, life just doesn't always work that way, right? Could be because the average borrower only keeps a mortgage 5 to 7 years in the U.S., and that's for all mortgages, right? That's an actual statistic that you could probably look up. So if that's the case, there's a very good likelihood that you're going to get cashed out before maturity. Now, when that happens, don't get upset, because usually when you get paid off early, your yield goes through the roof, which is cool, right? You can't complain that you're making a higher return. Now, some people, they will complain because now they have to go find another deal or find another note or find another house, that kind of thing. And that's kind of where people get, a little mentally twisted, but I never did. I would just go back and buy another asset, right? It never bothered me. Now, the other cool thing that can happen is where you're into a deal and, say you collected a bunch of payments and you got your money back. Well, now you might have an infinite rate of return on the payments that are coming that's left. Now, this happens more when you buy non-performing than performing. And the reason it happens with non-performing is a lot of times you're not only addressing a new payment plan with a borrower, a lot of times you bought that loan at a discount because it was delinquent. So you're working on a new modification of their loan, which could be new terms, right? That's why you're not as concerned about the initial interest rate on the original note and mortgage, because you're going to modify it if it was a delinquent asset. Well, now it's a little bit different ballgame, because now you can extend the term, you can lower the interest rate, you can do all kinds of neat things. But usually you're not only addressing the payment, you're going to address arrears or back taxes, that type of thing. So, you might collect some money. Well, there are cases where you collected enough money in arrears or in back taxes where it might have covered the cost of your note, right? So now you're kind of playing with the house's money in some cases, or you got most of your money back. And what's good about that is you're able to take some risk off the table. And then eventually, I have deals where it's an infinite rate of return. I've gotten all my capital back on that asset, and now you continue to collect payments until you finally exit the note, or they pay you off, or you sell the note, or you can borrow. You can do all kinds of things with notes. Almost anything you can do with a house, you can do with a note. You can borrow against the note. You can sell a piece of the note. You can flip the note. You can rehab the note. So that's what's kind of fun about notes, right? But today we're going to talk about some of the exit strategies. And, you know, usually you're going to exit through the property or through the borrower. And it also depends on whether it's occupied or vacant in a lot of cases. If it's occupied, there's a good chance you might modify it. If it's a first mortgage, you have different odds than if it's a second mortgage. These are statistical things. So with a second mortgage, you're usually exiting the deal through the borrower. With first mortgages, you're usually exiting the deal through the property. And if you're buying like a first mortgage that's vacant, there is a pretty strong likelihood you'll end up with the property. So these are just some of the scenarios. So let me see. Hey, Chris. Hello, Chris and Brandon. Just got on and got approved to buy notes today, which is pretty cool, right? So you're off and running. My buddy, all kinds of my buddies are on today. So it's cool. I'm glad you guys are joining us, learning a little bit about notes. So now I'm going to touch on some non-performing notes, right? Because that's where a lot of people, their minds go, hey, if I buy a delinquent asset, I'm going to get it cheaper. But there's also more work to do, right? So it's kind of like good analogy again is houses, right? So I can buy a house that's pretty much good to go, like a duplex, and just turn around and rent those units out. Or I can go buy this handyman special, and then now I'm rolling up my sleeves and I'm gutting the house and I'm renovating it, and I'm borrowing money. I have cost of capital and time tied up. Or I could have bought something that was rent ready, right? So I've done both scenarios, a lot of scenarios, renovated hundreds of houses. I can make arguments on both sides. Sometimes the quick turnaround ones are better, right? If I could do a paint and carpet and get traditional financing out of the gate, hey, that's a quick deal. Versus, hey, I got to use private or hard money and then tie up a bunch of time and energy and resources. So there's no right or wrong answer there. It's really, sometimes there were times I was doing both simultaneously, right? So we all do that too. So you take the good deals with the bad deals, and then sometimes you have to flip out some deals. Well, it's the same way in the note space, right? Sometimes it makes sense to buy performing loans. I buy them all the time myself, and obviously I have a company that buys non-performing loans all the time. So kind of do both, right? But when we're dealing with non-performing notes, usually, even if you get a hold of a borrower and you're a loss mitigation person, a lot of times those conversations initially with the borrower, especially if it's occupied, the conversations go around topics like a discounted payoff, right? So a discounted payoff is where you're offering like a reduced payoff to the homeowner. Usually, sometimes it's as payment in full, And think about it, you're doing it on a mortgage that you bought at a discount. So I'll give you an example. If you had a loan that you paid $10,000 for it, say it was a junior lien or something, and the face value was $45,000, would you accept $20,000 from the homeowner? And maybe 6 months went by, right? Pretty good return, right? 100% return, would you accept that? And there's plenty of note investors that would, right? So you can see how this is kind of popular with a lot of companies, especially if they specialize in low or no equity, junior liens, right? It's a common thing. A second area would be reinstatement of the loan. So you're talking with a borrower, and this could be a full or partial reinstatement, right? Everything's negotiable. And a lot of this is based on affordability. What can they afford, right? So some people can afford more than others. They can't give you what they don't have, right? But a lot of times when you're negotiating, arrears or back taxes, the more that a delinquent borrower can put towards arrears or back taxes, the more you could do towards payment or extending the term or lowering the rate. And it's kind of a tit for tat type thing where you're addressing both, and obviously the more they put towards arrears, it's less risk you have in the deal, and there's more you can do to modify the payment, right? And it makes sense. So you're trying to create these win-win solutions a lot of times in these cases. And sometimes whether you accepted a negotiated Discount on arrears, for example, is very common, especially in junior lien world. You'll see, hey, they owed us 10 grand in arrears. We accepted 5,000 in arrears. They were able to borrow money out of their 401k because because they have a delinquent mortgage and they're about to lose their house. They're able to borrow out of their retirement account penalty free, and reinstate the loan and start making payments again. Well, maybe they're making a regular payment. Maybe they're making a reduced payment over a longer period of time, but you get the idea how that works, right? So they come up with some type of a payment plan, and that's probably the third cooperative way when you're talking with a delinquent borrower, especially when it's occupied, right? So these payment plans are usually a mutually agreed upon payment plan, and the delinquent borrower starts to resume making payments. It's that simple, right? Nothing freaky or complicated there. And another scenario would be refinancing, right? So sometimes the homeowner can refinance the property. Sometimes they'll roll a first mortgage and second mortgage together. They do all kinds of things. I had a lady one time, not too far from where I'm at in Pennsylvania, where she met Prince Charming, got married, and Prince Charming refinanced the property and took out her once delinquent mortgage that she had with me, right? So people's circumstances change sometimes, and a lot of times they can't afford making payments for some type of life event, right? It could be death, divorce, job loss, medical. They're the four biggies. And sometimes bad things happen to good people, and but then time goes by and sometimes things change, right? You got divorced, now you're remarried, or you lost your job, now you found a job, or you were once sick and now you're better. So different things happen in people's lives, and they're able to get back on track. So, hey, if you're just joining us today, we're talking about Real Estate Note Investing 101, how to get started. And we're talking about the 4 parts of the note business: administration, risk management, borrower management. And today, we're talking about exit strategies, exiting note deals. And, sometimes the note deal is exited based on what the borrower wants to do. Now, this is a concept. This was really difficult for me to get in the very beginning. Maybe I was the typical real estate guy or the typical real estate investor, and I couldn't get my mind around, if I buy the note, I want to do it my way. Well, you're not buying a rehab project here, right? Like, if I'm buying a piece of real estate, it's like, oh, this is what I want to do with my piece of real estate. Well, when you buy a note, it's a little different. It's really what does the borrower want to do, not so much what I want to do. And then in most cases, I don't really care what they want to do. I just want to help them do whatever it is they want to do. And there's probably a win-win solution in there anyway. Well, that was a concept for me in the beginning. So unless you're buying, vacant first where you're trying to get properties, that's a different strategy, right? And that's fine. There's nothing wrong with that. And I'm not saying, I've never done that or people don't do that. They do. But when it's occupied and there's a borrower in it, you got to be a little more sensitive. It's a little different. It's really, what is the borrower's intent? Do they want to stay or do they want to go? And my approach is, hey, how do I help them do that? And can I create a favorable situation where we're all happy, right? And it can be done. And in fact, many times it's way more profitable that way too than actually getting the property and having to renovate an out-of-state property somewhere. A lot of times the best exits are through the borrower in a lot of cases, right? So I don't know if you guys are just joining us now. I see Mia, what's happening, and Melixa and Chris. Let me see if I can see anybody else. It's a little wonky on my setup here, but I'm trying to, if anybody has any questions, feel free to ask a question, make a comment, give me some love, give me a like, a share, a good review. If you can do a good review, that's cool. So we're talking about when a borrower is cooperative and you have a non-performing loan. And we went through a couple of them: discounted payoff, a reinstatement, payment plan, and refinancing. Another one is seller assistance, right? So a seller assistant usually means, we'll assist the homeowner with liquidating the property. And, sometimes we're able to help out in some different ways. Maybe we help with the realtor, we help with the movers, we help with a down payment. to an apartment, where we take over and help, handle that for them and take this. You got to realize sometimes people are in distressed situations. They just kind of want to walk away and get out of this, tough part of their life and move on, right? So that happens. Another way that we cooperate with a borrower sometimes is through a deed in lieu. They go, no, I don't, I can't afford it. It's almost like, I can't afford my car anymore. I take it back to the dealer and hand them the keys. And in this case, a lot of times we can provide an administrative fee for title cooperation, that type of thing, where it does save us a little bit of time and energy if they're able to do a deed in lieu. Now, keep in mind, you might want to know what the title situation looks like, what you're inheriting there. But it will speed up the process, and it can also save them from having a foreclosure on the record, right? So there can be an advantage there for them to do that, right? And there's an advantage for us too. So that can be, I don't want to say a deed and lose, a win-win situation, but it can make the best of a tough situation, right? It's another way, and sometimes that works well for a borrower that's cooperative. Now you get into, okay, now somebody's not cooperative, or they're underground, or you can't reach them, or whatever, and then you're obviously going down the foreclosure path, and have been sending out your notices and your demand letters and your notice of defaults and those types of things, and next thing you know, you have a sale date scheduled. Sometimes it'll sell at the foreclosure sale, and you're seeing a lot of that now, especially as equity's coming back into the marketplace. Real estate values are pretty much up in most of the states, or they're back to the levels they were before the last crash about, 10 years ago now, right? So you're seeing that happen quite a bit, whereas, the sheriff sale is a little more crowded. It's a little harder to find real estate deals. And if you think about the note business, it is in direct correlation to real estate values. So when real estate values go up, note prices go up, right? Now, some note investors complain about that. It's harder to find deals. The deals are more expensive. And I can do that too. I can say it's more expensive, it's harder to find deals, or my margins are a little thinner. But I can also say my portfolio is worth a lot more too, right? So it's really harder, I believe, on newer investors than it is on investors that have been around a while, because, like for us, my company's lived through an up market, a down market, and now we're in an up market again, right? And just like real estate, I've lived through multiple markets. I've been doing it over 30 years. So after a while, you kind of know, you change your strategies in the market, right? When I'm a real estate investor in a down market versus an up market, I do very different things. And I usually make money in both markets. I just change my strategy, right? And I think a lot of people get stuck in, I like to do things the way I always did them because that's the way I always did them, right? Well, it just doesn't work that way. So hopefully, if you guys have any questions, feel free to jump on. Somebody's asking me my opinion on Fundrise. I don't really know much about Fundrise. I've heard of them. But I really don't know what Fundrise does enough. So what's a good book or article to learn about notes? Well, hey, I can't resist. I know this good book. It's Real Estate Note Investing. That's a great segue from Joe. Thanks, Joe. I usually save this for the end, but if you haven't picked up a copy, you can get 20% off today if you use the code LIVENOTEINVESTING. 20% off. And a lot of what I'm talking about today is covered in chapter 15, which is exiting your note deal. There's also some great bonuses if you buy it through BiggerPockets. You actually get an ebook called Staying Safe. I did a video with Brandon. It's a pretty cool video. I did it with my partner Bob and Brandon on how to actually go buy a note. And we were looking at first mortgages, second mortgages, performing and non-performing. And we go out and we show different things that we look at, and we were like helping Brandon along to go buy a note, right? We're trying to get him in the game. And then there's also an audio called Avoiding Investor Mistakes with Mary Hart. And Mary Hart's a great attorney, asset protection, that type of thing. So if you get a chance, pick it up. If you haven't read it, if you like it, let me know. If you liked it or you didn't like it, that'd be cool. It gets me motivated, right? It helps me do more Facebook Lives. But anyhow, so we're talking about a delinquent mortgage. How do we handle it? Some of the exit strategies. It's not always up to you. Sometimes it's up to the borrower, but it's how do I navigate that best, right? So, and you can't really, this took me this was hard to learn in the very beginning of the business for me. When I was working with a borrower, because, years ago I worked with homeowners, I was in loss mitt myself. And one of the things that was tough was I'd be in talks with the borrower, and I had something in my head where I wanted that borrower to do, or I was hoping the borrower would do X, or hoping the borrower would do what I wanted them to do. And it's almost like you're walking down this path in the woods, and you come to a fork in the road, and like the borrower's going one way and I'm going the other way, and I'm like, hey, hurry up, come up, catch up with me. Well, it just doesn't happen. It doesn't work that way. It's almost like you're walking down the path hand in hand together, and you have to decide which fork in the road you're going to go together. That's a concept, and it's really hard for especially real estate investors like me to get that in the very beginning, because it's not which path I want to go with that deal. It's which path do they want to go, and then how do I help them along to the best exit based on what they choose. It's a little bit different than when you're in the real estate business, right? So keep that in mind. So probably the last part of the exit that I didn't talk about was REO, which stands for real estate owned. So what's an REO? And hopefully some of you guys might know what that is. But an REO is real estate owned, right? That's what it stands for. And it's when a bank has taken the property back after the foreclosure sale. Now, I know when I was, a real estate agent or rehabber and doing a lot of that, I used to buy a lot of REOs, right? I bought houses off Aquin and used to bid on the HUD sales, do all kinds of stuff like that. I still have my HUD keys. It's been a while since I've been in a HUD house. I never had too much luck with HUD. But anyhow, I would go look at these bank-owned REOs and did quite well. And a lot of times, I know a lot about REO agents. I know how they think and operate, they're definitely a different breed of folks. But the thing about REO is, you can get some good deals. You get clean title, right? You can see the inside. I always liked it much better than the foreclosure sale for me personally. I'm not a big fan of going into the bidding situation or not seeing the property, which can happen, right? Most foreclosure sales that I'm at, it's my attorney representing my asset, and I'm the guy, I'm the bank at that, right, at that foreclosure sale. But when it comes to the REO and buying REOs, I have bought many in REO and done very well. But you get, there's advantages, right? Now, sometimes, utilities aren't on or things like that. But when you've renovated hundreds and hundreds of properties, you know what a flat roof runs. You know what a heater is. It doesn't faze you. You kind of build that in. There's going to be something you didn't expect in there. I always have one of those fees in there in my estimate, right? But with the REO, it's what's your strategy again, right? Do I want to fix it? Do I want to sell it or rent it out? Do I want to fix and flip or fix and rent it, and in some cases finance it. I mean, there's been cases where I'll do the private or hard money deal on that REO property that we brought back. So there's a lot of different things. I could probably talk for a good half hour just on REO stuff, right? Because that's a whole nother topic in and of itself. When it comes to, everything from property preservation to changing the locks. Do I use plywood? Do I use clear? What do I look for in an REO? That's a whole nother thing, right? But usually think about it, these are situations where the borrower is probably not cooperating. And I know sometimes when you're having a conversation with a homeowner and you're going down their, a list of options, and a lot of times I would, in my scenario when I'm talking to them, it's usually pretty friendly. I'm trying to build rapport with the borrower. I'm trying to, what happened? Where are you at now? What would you like to do? It's really trying to find their pain point. What really happened? How can I best help these folks? And I used to do that in the way we buy houses business too, right? You're kind of doing the same thing, except you're doing it in someone's living room. Here, you're kind of doing it on the phone or however you're contacting the borrower, but you're trying to find out those pain points. What can you do to help? How can you try to resolve the situation? And when you're going over the options and you're telling stories of other people you helped, you're not really telling them what to do or what they should do. you're just telling them ways that you were able to help somebody else, and you're just planting seeds, hoping that something triggers that, hey, what you did for that family in Oregon would help me too, or what you did for that family in Delaware would help me too. So, sometimes those conversations are like I was saying earlier with the, people don't know they can access their retirement account when they're delinquent on their mortgage and get access to that money penalty free to bring their loan current or to pay it off. They don't know they can do that. Or we've had situations where friends and family step in and actually help get the loan reinstated or even buy the loan from us. We've had family, we've had an aunt or uncle or parent buy the loan, right? So that's a neat way. Sometimes they're able to access their, a life insurance policy, or they get an income tax check back, a refund check, and they're able to bring their loan current. Or, sometimes we work with them. Hey, if you can skip this and you can get back on track with this, we'll wait a little bit, or we'll help you out. You can do all kinds of things to get people, reinstated, get them back in a payment plan, help keep them in their home. So, it's very rewarding when you can keep someone in their home and still be profitable and end up with a reperforming loan. And in a lot of cases, once a loan's been paying for a good year, the loan's more valuable. And sometimes people say that too in an up real estate market. They're like, oh, how come you're not selling more assets? Well, think about it. As the equity comes back in the market behind the loan that you own, the loan you own becomes more valuable, just like pay history. As the pay history continues in a positive way, if it's a good economy, most people are working, right? We have pretty low unemployment. Well, it makes sense. These loans become more and more valuable. They keep going up, right? So why would I sell some of those loans, right? Now, we do sell some loans, but you get the idea. That's why people hold on to them, right? They're a good payment stream. It's just like if you have a good rental property, why would you sell it? Now, there's always times when you need to sell it. You're retiring or you're moving south or whatever you're doing, right? You might want to sell. But those things happen, right? So the same way with these borrowers, you go through all their options, and a lot of times when you're going through the options where they get to stay, and they might be going yeah, or they're not reacting very well, and then you start getting to the options of do you have your house on the market currently or something like that. You have these conversations. Have you thought about selling? And now the options are with them out of the property. Well, some of those earlier options might not have sounded so bad, and they revert back to, hey, what about that payment plan thing again? So it depends on the borrower, but you get the idea. So a lot of times, hopefully some of this stuff resonates with some of you. Hopefully you're learning something about this. I don't know. So here we go. Dr. Luigi, property's owned by the bank and is on the market for sale. I believe it's better to get a deal with the bank than dealing with the sellers. Could be. I don't know if it sounds like you're talking about a short sale, so I don't know where you're going with that question. But guys, yeah, like I said, if you guys have any questions at all, would love to help answer these. We're talking about exit strategies for your notes. It's kind of similar to recapitalization, because if you sell your note, you do get paid off, but sometimes your exit's through the borrower and you get back into a payment plan. Once your loan gets performing, again, you can sell the note, you can borrow against the note, you can sell part of the note, you can sell partial. So these are all great ideas. Talk about a lot of this stuff in my new book, Real Estate Note Investing. If you haven't picked up a copy, you might want to. 20% off if you buy through BiggerPockets, and the code is Live Note Investing. So please try to pick up a copy if you haven't, and I think it'll help you out. It's a good general overview of the note business. It's not going to tell you everything about the note business. It's only a couple 100-page book, right? But it's just like real estate, right? Can one 200-page book tell you about every aspect of real estate investing, from cemetery lots to REIT? I doubt it, right? So, but anyhow, I do want to let everybody know our next Facebook Live is going to be on October 3rd. And we're going to be covering, do you need an LLC or not? And we're going to go over some, entity selection concepts. Now, I'm not an attorney, I'm not an accountant. I'm just going to give you the street version, so to speak, of, what should you do, what shouldn't you do, when do you do it? A lot of it's timing, right? Or when do you have enough when does it make sense to do certain things? And a lot of people don't talk about that, right? They just go, oh, everybody needs this or everybody needs that. And I don't really believe that. I think it's, you need different things as you grow in whatever your business is, right? So also we have a Note Investor Q&A session coming up. Our next one's not till November 19th at 8 p.m. Eastern. You can sign up for that at PPR's site. If you go to PPRnoteco.com, you can find out other information there too. You can sign up for our email newsletter that comes out weekly. There's always a note for sale in there usually, so if you sign up for the e-zine, you can you'll see a note in your inbox every week. We also have a new liquidity fund that just came out. Some people might be interested in that if you're a high net worth investor and you're looking for a liquid fund that invests in notes. You can get your capital back quickly if you need it. So an interesting twist as well. So I appreciate everybody getting on with me today, and I'll see you soon. Thanks, guys. Thanks for hanging out with me today. Take care.